In today's episode of the Daily Brief, I'll talk about two interesting stories. I first talk about the acceleration of India's auto ancillaries, and finally, I talk about whether Shiprocket is a platform or a broker. Welcome back to the Daily Brief show by Zerodha, where our aim is to simplify the biggest news in the financial markets in a way that's one level deeper as compared to news channels. I'm your host Akshara, and today is Wednesday, 17th December. Coming to the first story. Recently, we broke down the business model behind auto ancillaries. It's rife with hazards, from razor thin margins to tight delivery obligations to years of capex before earning anything. But over the last few years, Indian auto ancillaries have been growing incredibly fast. Between FY22 to 23, the industry grew by a whopping 33% to Rs 5.59 lakh crore, the fastest yearly growth ever. Since 2020, the industry has nearly doubled its revenue to approximately Rs 6.7 lakh crore. In fact, in Q2 this year, two companies, Uno Minda and Sona Comstar, actually had their best quarter by revenue. Now, that kind of growth rarely happens without a structural cause. And right now, Indian auto ancillaries are going through multiple such changes, which are changing the landscape of the global auto industry. Now, those changes pose both opportunities and risks, and Indian suppliers are trying to position themselves in the best places possible to take advantage. So, what's driving this transformation? And what risks come bundled with the opportunity? Let's dive into the major trends shaping this industry. The first tailwind is one that we're probably quite familiar with, the China plus one strategy. So, in the last 5 years, global trade has been completely ruptured by multiple factors. For one, there's an active US China trade war, and secondly, the pandemic brought entire supply chains to a halt. Western automakers decided they'd had enough of putting all their eggs in the China basket and began actively diversifying away from them. India emerged as a preferred alternative. Cheaper labor, a large domestic auto market, and most importantly, an already established ancillary ecosystem. This shift has put India's auto parts industry, which has always been domestic heavy, into overdrive. Exports have risen significantly since the pandemic, reaching approximately Rs 2.1 lakh crore now. The biggest source of demand comes from the US, but Europe and Asia also account for substantial shares. Because of this, India has flipped what has historically been a trade deficit in auto components into a trade surplus. So, for a long time, this export boom was mostly driven not by breakthrough product innovations, but cost advantages in labor and other processes. India won orders because it's cheaper and had dependable processes, not because it's inventing new technologies. However, that is also changing, and that's where the second trend of premiumization comes in. Indian consumers are no longer buying bare bones utility vehicles. Increasingly, they want their cars to be rich with features like advanced infotainment, ADAS sensors, upscale interiors, inbuilt dash cams, and so on. This wave of premiumization is also transforming the suppliers of those components where they're looking to move up from just selling simple commoditized goods to higher value, potentially higher margin goods. As we'd mentioned in our primer, auto ancillary is a sticky business. Automakers don't like to switch away from a supplier they've locked in. Suppliers have used that largely to their benefit. They may start with something as simple as decals and paints, but eventually move up to providing advanced interiors for the cars as well. This upselling and bundling has expanded kit values per vehicle by 3 to 4 times for certain categories of ancillaries. For instance, SJS Enterprises has quadrupled its content per car from Rs 1,200 to Rs 3,500. Lumax Auto, meanwhile, went from being a mere plastic assembler to now designing whole cockpits for Mahindra. Uno Minda, meanwhile, has moved from simple 500 rupee halogen bulbs to complex LED setups worth over Rs 10,000. Now, this isn't just about selling more or better parts. It's also about moving up the intellectual property ladder. Historically, Indian suppliers built as per the licensed designs of foreign firms, but now many are developing their own designs. For instance, Sona Comstar owns key IP for gear design and software. In some cases, if they don't invent their own, they may even acquire them from elsewhere. For instance, Samvardhana Motherson, the largest Indian ancillary, acquired Germany based Dr. Schneider in 2023, adding over 200 patents related to high end interior lighting. Let's talk about the electric feel. So far, so good for Indian auto ancillaries. But much of this base has been built on the back of internal combustion engine or ICE cars that use petrol and diesel. Almost all Western automakers also continue to be reliant on ICE cars. And that brings us to what is perhaps the most important structural trend in the sector. So, how do EVs change the game? See, EVs need far fewer mechanical parts than internal combustion engines. No engines, no multi gear transmissions, fewer moving components overall. Many Indian suppliers built their business around these products, which ICEs now need much less of. Instead, EVs use far more electronics than ICEs. A mainstream shift to EVs, especially in export markets, could hollow out the very product lines that made China Plus One attractive. Now, the threat goes beyond just obsolescence. Effectively, EVs bring back China to the center of the global auto value chain, and this creates the possibility of increased dependence on China. Except where earlier the dependence was on auto parts, now it's on fully assembled cars. In fact, even with such a mature industry, India imports approximately 30% of our auto components from China. But Indian ancillaries have hardly backed down from this challenge. In fact, they're adapting with speed. Take Sona Comstar for instance. Originally a transmission gear and axle maker for ICE vehicles, it pivoted to driveline products specific for EVs, like e-axles, motor shafts, and hub motors. It now derives approximately 30% of revenue from battery EV vehicles and supplies EV makers globally. Sona even engineered a ferrite based motor that avoids scarce rare earth magnets, an important innovation considering China's iron hand grip on rare earths. In fact, Indian suppliers have also been willing to work with Chinese suppliers themselves in different capacities to master EV components. Uno Minda, for instance, signed a joint venture deal with leading Chinese automation firm Innovance to make specialized EV parts. In fact, we have covered before how Indian battery firms like Exide and Amara Raja are working with Chinese firms to make their own. First, Western OEMs diversified away from China to India for ICE parts. Now, Indian suppliers are looking to work with and even supply to Chinese automakers. However, this doesn't come without scrutiny. For instance, Sona Comstar's partnership with Chinese firms Jinite Machinery has been held off due to geopolitical factors. So, is this the return of vertical integration? The EV disruption is also bringing back something that ICE cars had done away with: vertical integration. In our primer, we covered how the auto industry increasingly fragmented, going from a single firm having end to end control of a car supply chain to different firms existing for different auto parts. But EVs are reversing that trend. BYD, for instance, manufactures approximately 75% of its vehicle components internally, allowing them to manufacture for much cheaper. In contrast to ICEs, vertical integration in EVs is now yielding a huge cost advantage. So, why does vertical integration work in EVs but not in ICEs? So, EVs have fewer parts, so there's much less to outsource. In fact, the most important component of an EV, the battery, alone accounts for approximately 40% of the cost of an EV. So, if you control the battery and all that goes into it, you achieve a cost advantage. Now, what this means for Indian auto ancillaries is unclear. What happens if Indian automakers, for instance, start excelling at making EVs? Will the economics then go against these ancillaries, even those who make EV components? This may not be necessary. Even China has many players who supply EV components individually, but it's certainly worth thinking about. A few Indian companies, in fact, might be experimenting on these lines. Take Tube Investments of India or TII, for instance, which makes chassis systems and steel tubes. Recently, it launched its own electric three wheeler brand under TI Clean Mobility with plans for electric trucks and even EV tractors. Additionally, it also acquired an electronics firm to ensure easy captive supply for its EVs. This is a case of forward integration, where a component maker decides to make the vehicle itself, securing supply of the parts through itself for cheap. Now, coming to diversification. So, the last major trend is about hedging bets. In our primer, we mentioned how auto ancillaries are attempting to diversify across automakers, geographies, and even industries, entering defense, healthcare, and so on. Given how sticky and unprofitable this business is, diversification becomes a method of building resilience. The largest players like Motherson understand this well, and that reflects in their business. One could even say that hedging between EVs and ICEs right now is important, since neither technology has established full dominance yet. It may not be wise to try and secure the future by completely giving away a key strength right now. And another important method of diversification is between passenger vehicles or PVs and commercial vehicles or CVs. For one, PVs and CVs require different customizations and parts that otherwise serve a similar purpose. A truck that handles tons of cargo, for instance, will need a different family of similar parts than a family oriented SUV. Additionally, their business cycles work very differently. If consumer demand slumps, PV sales fall. However, infrastructure spending might be up at the same time, keeping CV demand afloat. In fact, this quarter, that's exactly what played out with Bharat Forge's business. Exports to American CV makers fell, but that fall was made up by growth in the PV and industrial product lines. Another hedge is within the PV space itself between two wheelers and four wheelers. Usually, two wheelers are a proxy for the rural economy. So, if growth there is fast while urban four wheelers stagnate, then a firm that is hedged well can benefit from that. In fact, Uno Minda's business is evenly split between two and four wheelers. Now, let's discuss firm footing. India's auto ancillary industry has transformed dramatically over the past decade. It's no longer the low cost build to print supplier base of yesteryear. They're expanding globally, investing in R&D, developing EV compatible products and moving up the ladder. But the risks they face are equally real. The same EV transition creating opportunities for some could hollow out legacy product lines for others. Meanwhile, import dependence on China for critical inputs continues to remain a vulnerability. Who the winners of this market will be is still very undecided. But as a whole, the Indian auto ancillary sector is finding a pretty solid footing in these rapidly changing times. Now, coming to the second story. In today's age of e commerce and quick commerce, it might not seem that way, but a surprising amount of Indian retail still happens offline. In China, for instance, 34% of retail activity happens through the internet. In India, we're still at approximately 7%. It's reasonable to believe that this number will grow. Put yourselves in the shoes of an Indian retail MSME that wants to serve customers online. You essentially have two options. There's the easy one where you plug into a platform like Amazon or Flipkart and benefit from their entire suite of services. That does, however, mean that you face brutal competition, often from the platforms themselves, and can bid goodbye to your data. Then there's a harder answer. You take a series of tools web portals, payment services, marketing and advertising tools, logistics, warehousing, and more into a single stack. If you can marry them seamlessly, you've become a full blown D2C player. But that's not easy to do. Now, there's room for a platform that just builds a commerce enablement layer, a platform that handles all these backend problems for you. As a small business, you just plug your website or app in and then focus on making things to sell. That's the dream behind Shiprocket. The company is gearing up for its initial public offering, an issue worth rupees 2342 crore. Of this, the company itself is raising rupees 1100 crore while the rest will go to exiting shareholders. The company just filed an updated draft red herring prospectus giving us a window into the company. So here's the pitch. Shiprocket thinks of itself as an operating system layer for Indian businesses. It operates a platform that connects merchants to a network of third party service providers, logistics and shipping firms, payment providers, warehousing companies, NBFCs, communication platforms, and much more. Now, that isn't how many of its customers see it. Many of its customers see it as primarily a logistics aggregator. To the company, however, that's simply where the funnel begins. The company's big success lies in its ability to draw customers in at low cost. Millions of visitors land on its site organically every month, and a large number of them become customers without any intervention from the company itself. Now, the company's customer acquisition costs have been falling steadily over the years, from nearly rupees 4,800 in FY 2023 to just over rupees 2,800 in the first half of this year. In fact, 96.92% of the merchants it adds for its logistics business don't even require the intervention of its support function. The company's pitch is that it can take this pool of customers, cross sell all its other services to them, and eventually increase the revenue it earns per customer. According to the company, if a customer buys into their full suite of services, it could pocket as much as 20% of its customers' sales. That is really what makes it a platform. Otherwise, it's simply a shipping middleman. Two businesses in one? But how does this pitch actually hold up? In practice, Shiprocket has two major revenue streams: its core business, which revolves around shipping, and its emerging businesses, which take many forms from warehousing to inventory management to advertising and marketing to credit. At least so far, the fates of these two businesses are entirely different. Overall, the company is in a phase of rapid growth. In the 2 years between FY 2023 and FY 2025, its revenues grew at a CAGR of 22.43% from just under rupees 1090 crore to over rupees 1630 crore. And with that, its unit economics is getting better as well. But those revenues break neatly into two pools. Four-fifths of its revenue, over rupees 1300 crore last year, comes from shipping. This is a reasonably mature business line, and the company claims that it has been profitable since FY 2022 itself. With time, it's also been able to scale without increasing costs proportionally. Analysts often measure the unit economics of a business through its contribution margin. For each rupee a company earns, this tells you what's left once you strip away the costs of actually providing that service. Shiprocket's contribution margin from this core business has gone up from below 16% in FY 2023 to over 21% just 2 years later. The rest of its revenue, under Rs 330 crore in FY 2025, came from its emerging business lines. These, however, have been bleeding money. Its EBITDA margin from these lines is a negative 45.97%. That is, for every rupee the company earns, it spends almost one and a half in operating costs alone. Now, here's a rather damning way of looking at it. In FY 2025, the company's operating earnings from its core business, four-fifths of its business, were just under rupees 157 crore. Meanwhile, it lost rupees 150 crore in trying to provide those emerging services, just one-fifth of its business. In all, its adjusted EBITDA, which the company arrived at after knocking off some share based payments it made, was barely over rupees 7 crore. In other words, all those emerging business lines drove its earnings down to practically nothing. Here, then, is the big question: why aim at becoming a platform at all? Why not operate as a simple logistics broker? So, simply put, even with a digital skin, it's hard to survive as a pure play logistics middleman. It's a business with a low ceiling, low margins, and missing moats. So, is an opportunity really there? In theory, Shiprocket considers its total addressable market in the ballpark of rupees 8 lakh crore. Naturally, with revenues under rupees 2000 crore, that's a distant dream. At the moment, its shipping services, the heart of its enterprise, are growing at a CAGR of just over 16%. That's healthy, but it's hardly the sign of an exploding business. If it were to stick to shipping, where would the next chapter of its growth come from? Now, there are untapped opportunities ahead of the company. Only these aren't easy to capture. The biggest, for instance, is helping small businesses ship their exports to other countries, which the company thinks could climb to rupees 5 lakh crore. And recently, the company began tackling this market. In the first half of this financial year, it helped businesses ship over rupees 300 crore across borders. While there's certainly a case to push this business ahead, though, it comes with serious frictions. It's a space where one has to deal with international regulations, customs, and more, all while trying to cut timelines. If you're also expected to handle returns, it becomes doubly difficult. Perhaps Shiprocket can learn how to tackle them over time, but that isn't guaranteed. There are similar problems with many new segments the company is trying to tackle, from same day hyperlocal deliveries to social commerce. Now, it's not that these opportunities don't exist, but they all require a whole new way of thinking about one's operations from scratch. Whether the company can pull that off is an open question. Let's talk about the tricky position. Meanwhile, even the company's current position is hard to hold on to. The company is effectively an aggregator for third party logistics providers. It helps businesses connect with multiple logistics services, routes orders between them, and helps with communication and tracking. It does have some nifty features, from AI enabled routing to a system that plugs in well with the workflow of a business. But ultimately, the actual work of taking a package from point A to B is carried out by someone else. Naturally, that's where most of the money goes as well. The company's cost of merchant solutions, or delivery fees, communication costs, manpower, etc., eats up nearly three-fourths of its revenue. That is, for every 100 rupees that comes to the company, almost 75 rupees is instantly paid out to their partners. The remaining 25 rupees is how they meet all their other costs and their own earnings. And if those partners try to negotiate higher rates, its margins could shrink even further. Now, this isn't a distant fear. The company's vendors include some of the largest in the business, from Blue Dart to Delivery. These are large, powerful entities with genuine negotiating power. If they feel like Shiprocket's stake is too high, they could easily push back. A squeeze in margins is one thing, but there are bigger challenges still. A large enough vendor could directly challenge Shiprocket by building out a better dashboard and software interface for itself. And this is already an industry with low switching costs. A business loses very little by moving to another logistics provider. So, if these vendors can undercut Shiprocket by enough of a margin and offer a seamless enough user experience, those customers could easily leave. And this puts Shiprocket in a tricky spot. It must pay its vendors well while keeping its own prices low. If either side thinks it's eating away too much value, they could move away. This is why Shiprocket has to find ways of locking its customers into its platform. To them, the challenge is existential. That stickiness is arguably what they're trying to buy through all those bundled services. Let's talk about how Shiprocket needs a big win. Shiprocket is at the moment a loss making business. It saw its first positive cash flows last year, but that's still one setback away from a reversal. It has a healthy business as a shipping aggregator by all accounts, but not one that can justify a valuation that runs into tens of thousands of crores, at least not yet. Its longer play of becoming an end to end e commerce platform for small businesses is not a guaranteed success. With massive amounts of investor capital and debt on its books, the company needs a way to get success. Where that'll come from, however, isn't entirely clear to us. The company has made mistakes before. In the last few years, for instance, it impaired its goodwill from the acquisition of startups like Picker and Swiftly. Accounting speak for the fact that it perhaps paid more than it should have. Now, please don't take this as investment advice. We are just nerds who poured through an offer document, something you can do as well. But the way we see it, to prove its worth, Shiprocket needs a big win. Now, coming to the tidbits. Flipkart received NCLT approval to shift its domicile from Singapore to India, moving closer to its planned 2026 IPO. The company, valued at $35 to $36 billion, now awaits government clearance under Press Note 3 rules. Now, coming to the next tidbit. NCDX received SEBI's in principle approval to launch a mutual fund transaction platform aimed at enabling micro SIPs in rural areas and serving as a precursor to its planned equity segment. Now, coming to the final tidbit. The US has paused a $40 billion technology agreement with Britain covering AI, quantum computing, and nuclear energy, citing frustration over UK digital regulations, digital services tax, and food safety rules. You can check out all the links in the description below. That's all the news I have for you. Thank you so much for watching, and see you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.